Hello, everybody. Welcome to Friday, another show of Go Live with Tom. This is a really fun format. We've been having a great time doing this so far. And so what you do here is there's an email address, says right there, ask Tom at golivewithtom.com. You just send in your questions that you might have, or even topics that you'd like to talk about, maybe even some topics you want us to cover, in the next week, and those types of things. And Katie, who's here on the bottom, is our moderator. She'll be, asking the questions, so she'll send them into Katie. And then Eason, who's next to me, is another one of the advisors here at Retirement Capital Strategies. You can ask him questions directly if you'd like, but he'll also be asking maybe some follow-up questions to kind of build out the subject and make sure we get, everything covered that you might want to see as far as that goes. So really fun. Again, if you're interested in, educational content about investing, about financial planning, and about tax management, that's what this show is about. We believe at Retirement Capital Strategies that one of the best ways to build your wealth is to continue your educational, path as far as that goes. So we are posting, videos on a regular basis on our YouTube channel, which is what you're on right now. And so if you'd like to see those on a regular basis, you can hit the little subscribe button. And then right next to that, if you'd like to get a notification when we post a video, you just hit the little bell as far as that goes. So that's the process. Super simple. We actually had some questions come in that I've kind of built out some answers to. We'll start with one of those here too. So I think today will be really fun. So go ahead and start firing in your questions, and we'll get through the show here. So why don't you go ahead and cover that first question, Katie?
Will do. Thank you so much, Tom. So in the past, we've talked about the bull versus the bear market before,
Mm-hmm.
and just straight off the bat, we have a pretty amazing question in from one of our clients asking, since we are at the last stage of the bull market, we are anticipating the end of the bull market at the beginning of a bear market in a couple years from now. What would you do to prepare for the bear market, and how would you invest our money in this situation in a transition from the bull to bear market?
Yeah, it's a really good question, actually, and there's a whole bunch of layers in there that I'll try to cover. But the first one, and I think probably the most important thing to look at there, he's asking about preparing for a bull market. And so one of the things that you have to think about in terms of preparation for a bull market is just how much stock versus bond that you have in your portfolio. So like the total risk of the portfolio, which is super important. And we have some data going way back to 1926 that's provided by Vanguard that kind of
Wow.
shows for each level, 10% stock and 20% stock, historically, what was the worst 1 year period. And so it kind of gives you an idea for what you're getting involved with in terms of that total risk. So that's one of the ways that we prepare for a downturn of any type, even the smaller ones. And so that's how you kind of can moderate some of the risk in the portfolio. But beyond that, I mean, truly preparing for a downturn is what I call predictive. And what I do is what's called reactive. So, and there's a big difference there. I don't believe you can predict the next bull market. I believe that they will happen, but I don't know when they will happen. There could be one that starts on Monday, or it could be 15 years from now. And so that's the hard part to really tell, is like when it's going to happen. So I tend to get the clients into this mixture of stock versus bond. Maybe it's 100% stock, maybe it's 60% stock and 40 bond, or whatever the mixture is. And once we get that, we basically manage the portfolio as if the market's going to continue up, and then we try to react to those downturns. Let me share my screen, and I can show you some different pieces here that I think are, going to be useful. So this is the S&P 500 for the last 25 years. And so each one of these little dash bars here is a month. And so you can see, we had our 2000 downturn, right? We had our 2008 downturn, and we had our, just this pandemic downturn that just happened last year. This was about 40%, about 60%, and here's 35%. And this is actually the fastest 35% downturn in history. But one of the things you have to pay attention to here is that month by month, if you look at this, there are more up months here than there are down months, and there's more upturn altogether. There's only three big downturns that have happened in this 25-year period. And so you have to kind of assume that the market's going up because the probability is that the market is going up. And so that's kind of one of the first things that we always think about, is trying to stay invested as much as possible. But then you want to put in some protections over a period of time to try to figure out, what you might do if things do start to go down. Uh, and so some people will just buy and hold, and I have clients that want to do that, and we're fine with that also. You just got to make sure that you understand what that means as far as that goes. But I'll show you what we did in this particular downturn here that just happened in the pandemic. So the first thing that we do is we use these stop losses. So let me pull up a different chart here. So here's Apple for the last 12 months. And so again, every one of these little boxes is a day, right? And this is the 200-day moving average. And this is a very important portion of this chart. This is what's called the volume profile. So this shows, each one of these bars shows how much volume or how many shares essentially were transacted at that particular price. And so you can really see, where things were purchased. This red line shows the highest volume of purchase for the time period for the year. So the first thing I'm going to do here is I'm going to start to put in alerts, and I'll just show you how I do this. So one of the things that is very common within the trading community is this 200-day moving average. And oftentimes when a stock falls through the 200-day moving average, sometimes it'll accelerate down from there. So I'm going to put an alert, really right here, right under this 200-day moving average. I'm not going to respond to that, especially for a company like Apple, but I do want to know that that happened. So there's an alert. I'm going to put a second alert right here at the highest level of volume. And what I'm trying to do here is really identify these areas of high support. So what happened is, if you look throughout this year, more shares were transacted at this price than any other price. And so often when the market comes down and gets to that level, you'll see a bounce. But if it happens to crack through that level, then we've just broken that support. And if you look down here, and this is where I would put my stop loss if I had or at least an alert. I use both alerts or stop losses. Depends on what I'm trying to do here. And so here you see there's basically no volume underneath. So if it gets through here, it could fall all the way down. And that's a fairly big, significant motion. So that's the reactive portion. I'm getting notified when things are happening, and then eventually when it gets down bad enough, I might reduce my position or eliminate that position. And so we did this year when we had the huge run up early in the year and all the clean energy and what have you. We put stop losses in place, and it worked out really, really well. So that's the first piece. And then let's say that something triggers, then what do we do with that money? Well, the first thing I do is I look for, let me pull this chart up. Oops, sorry. I look for positions in the market that are doing better than the market itself. So this purple line right here is the Vanguard Total Stock Market Index. It's the ticker symbols VTI. I love using this because it's essentially every stock in the stock market. And then this line here right now is Apple. Okay, so you can see that Apple fell a lot less during the downturn, because this is from the very top on the 19th of February of last year to the very bottom here, which is the 23rd of March. And so it fell a lot less, and then it actually ended up kind of continuing its movement upward. So it was down 10.6% instead of 17. So I like to rotate those pieces that we've freed up with these stock losses into holdings that have fallen less than the market. And the other piece of this that's super critical, it's not just trying to protect how much you lose on the downside. It's actually more important on how fast you bounce back. So I'll give you an example. Let's say you have a portfolio, two options. One where the portfolio would drop 30%, but you'd make your money back in 3 months. And another one where it only drops 3%, but you'd make your money back in 3 years. I would personally take the negative 30 because it comes back that quickly. So it isn't just how much it falls, it's how fast it comes back. And one of the things that I've seen is if you use the data that's coming to you when the market is falling, and you start to rotate into those things that are falling less, oftentimes they bounce faster and come back faster. So I got some other examples, and we bought Apple on the 5th of March. We also bought Microsoft on the 5th of March, and you can see great bounce, down 6.8% instead of 17. We also purchased healthcare. Again, huge bounce, down 5.6% basically instead of 17. And these are things that I saw falling less than the market, and we rotated into those. We also bought cybersecurity because everybody was going home, and that was, and that's down 7.5% instead of 17. And we bought genomics. This is iDNA, and that was actually up. And that's such huge bounce, right? This actually included Moderna in it, which obviously became something everybody got to know pretty quickly. And so that's the second part of the strategy is just that ability to get into something that is falling less and hope that that bounce is higher and faster and we can recover quickly. Now I didn't buy these up here I bought them in this down time frame here just because I could see that they were falling less than the market, and that's what I'm looking for in downturns. I start scouring through because what I'm seeing is that the market is saying, hey, we still like these things more than the market as a whole. And like for Apple and Microsoft, they have huge cash positions. For this particular one here with this genomics piece, obviously, they have some need for a new vaccine. And so that, the market is automatically telling you, what they're still interested in. And so that's a really big deal. And we did this. These are actual trades that we did during this downturn. And the other thing that we did with some of these pieces that came out of the stop losses and what have you was to move into long-term treasuries. So if you look at this, this is it's called EDV, right? It is a Vanguard Extended Duration Treasury. During times of stress, people fly to treasuries because they're safer. And then usually there's an interest rate decrease by the Federal Reserve in these big downturns. And so that also helps the price. And you can see that this was actually up 19.8%, in the same time frame when the market was down 17. So we will put 5 to 10% of the portfolio into something like this, into these kind of long-term treasuries. So even if we have a 100% stock portfolio, we might go down to 90% stock and 10% long-term treasuries and those types of things. And so this was a strategy that we used very successfully, actually. Then kind of the last piece here really is the ability to use an inverse position. And so an inverse, this is pro shares, and this goes in the exact opposite direction of the S&P 500. So if you look at this run right here, it's up 40% from that point that it starts, and the market's down 35. So it goes the exact opposite direction of the S&P 500. And so that's another piece. But then you can also see as the market recovers, right, it starts to go down, unlike what you saw with the Treasury. So we didn't actually use this during the downturn, during the pandemic downturn in February or March of last year, mainly because it was just so fast. Because we kind of go step by step. First we have the stop losses, and then we're rotating into stocks that fell less, and then we're moving into things, like the extended duration treasuries. And then we would have used this, if it would have continued to be a problem, we would have started to use some inverse. We're not actually looking to make money in a downturn on the stock market portion. We're just trying to slow down some of the descent. And by slowing down the descent, what we're doing is really trying to get the recovery to come back faster. And so everybody has to take a certain amount of risk in their portfolio because we can't predict when these things are going to happen, but we're going to, make these step-by-step changes throughout these downturns. So I don't prepare a portfolio for a downturn in advance. That's predictive. I do a reactive scenario where I go through these steps. And these are steps that I've defined and honed and worked on for, my 35-year career. And it worked great. I mean, we did really, really well here, and our bounce was very strong. We came back much faster than the market across the board. And we did the same thing with the ESG portfolios. There's a lot of different pieces there that we can look at too. So really, that's the answer to that question. It's obviously kind of a long answer for a short question, but it's probably one of the most important things that we do is that process and kind of what we've learned there as far as that goes. Then you got to go the other side, which is how to unwind all of those things. How do you unwind the treasury pieces and get back? And how do you unwind, if you have an inverse, how do you unwind that? How do you get rid of it and go back to the market? Which is a whole nother subject. But anyway, those are the basics for how it works as far as that goes.
Thank you again, Tom, for yet another great visual and great answer, very thorough.
Yeah.
So let's talk pre-retirement. We have another question in here asking, what financial advice would you give yourself if you could give it to yourself when you were, say, 20 years younger?
Wow. Okay, so here, just, I've done, I think, about 6,000 financial plans altogether over my career, dealing with,
Wow.
hundreds of millions of dollars and a lot of very wealthy clients. And there is one characteristic that they all have, all of them, and that is the ability to save. Um, and so it's kind of funny because so much effort is placed on, how to invest, you know, what to invest in, and all these different types of things. I would say that of my wealthiest clients, only a few of them are really good investors as a whole. For the most part, what they are is really good savers. And I've heard comments, over and over, like, well, my father told me to just, put aside 10% of and pretend like it's not there. And so, I always pretend like some portion of my money isn't there, and I live off the rest, and that money just continues. So if I, 20 years ago, I'd really hammer that home to myself about saving and continuing to consistently put money away, no matter what's happening, trying to live off of the rest and save, some portion of the overall income. And so that's a big one, because I've met people that are fantastic investors and not great savers, and they don't have that much money just because they don't have that much money to put into the investments if they're not saving. I think the other thing that I would think about there, I think this would have been appropriate. I would try to save as much as I possibly could into Roth IRAs or Roth 401ks. I would like to have tax-free growth. I recently converted, all of my IRAs and 401ks over to Roth. I wish I would have done that a long time ago, when I was younger, just because it's really painful to pay the taxes on that conversion now. I'm 56, I'm about 57 next week, so almost 57. But so I have a long time to let that still grow tax free. But 20 years ago, so say 37, that would have been an unbelievable time to, because I've had great rates of return in my IRAs, and I would have loved to see that be tax free. So I would, been talking to myself to save more than I did, and to really look at these tax-free growth vehicles like the Roth, which I believe came out roughly 20 years ago. But yeah, that sounds about right.
Great. So looking at the difference between a 401k and a Roth, why would you say that you prefer the Roth now versus a 401k?
Well, 401k actually has two different versions. One is a traditional 401k, which is what most people are familiar with. So traditional 401k, grows tax deferred. You get a write off when you put the money in, and then when you take, the money out, you pay taxes on it. And basically, what I have seen is that that can be a tax time bomb. And this is what I've learned in my practice is I've got all these clients in their 60s, 70s, 80s, and beyond, actually, that have these very large tax deferred 401ks. And now, once they get past 72, they're being forced to take money out. And you can end up with a situation where you end up with four or $500,000 worth of taxable income coming out of your accounts, and it is literally, it's just a giant tax time bomb. Whereas a Roth, and there's two different versions. So there's a Roth 401k, your company has to offer that, or there's a Roth IRA. And in both of those cases, when you put the money in, you do not get a write off. And so that's the disadvantage, but it does grow tax free thereafter. And so, again, if you look at your entire life, I would give up the write-off that year for the tax-free growth for the rest of my life. And I've done the numbers on that, and I really believe that that's a huge issue. I also believe taxes are probably going to be higher later on in my life, because tax rates are fairly low right now, those types of things. So that's the difference between kind of a traditional 401k and, say, a Roth 401k. Um, so I'd definitely be looking at that Roth 401k if it's available.
Hmm, thank you. So we have another great question. Oh, sorry, go ahead, Ethan.
Oh, so another question is, what are some ways to, I guess, combat the high tax or income flows from RMDs? Is there any like good strategies that we could use?
Yeah, well, it's kind of difficult because there isn't anything, really, really good in that sense. One thing you can do is get quite organized on all of your income sources to try to get more unrealized gains, let's say, for example. So if I have a whole bunch of money sitting around getting interest and dividends and those types of things, and I'm about to become 72, I might want to reposition some of those to reduce the income flow from those if I can, especially if I don't need it. And I would buy things that have more, long-term gains that are controllable. Like a lot of these growth, exchange traded funds don't pay out their capital gains every year. So I want to control the existing taxes that are coming out of my investments as much as possible first. And then second, I really want to take a look at trying to possibly do some Roth IRA conversions. And so, because that, even if it's small amounts, just keep pushing money out of that IRA and convert from the IRA or Roth or traditional 401k to a Roth IRA, even after 72, because it's just going to reduce that future tax liability that I have. And so anyway, those would probably be two of the strategies that come to mind on how to try to do that. But it is difficult because you can get kind of stuck. And I've done some projections where people are looking at very, very high incomes at some point. Where they got rid of pensions and they replaced it with 401ks with matches. And so now all of a sudden we're starting to see people retiring with $5 million in 401ks. I just read an article the other day that said there's more millionaire 401 more 401ks worth $1 million or more than ever. That's fantastic, but they're looking at a tax time bomb. If they really sat down and looked at how much that's going to grow and what's going to happen in their 80s and early 90s and how much taxable income it's a disaster. So I would be really focusing on my other taxable incomes, trying to reduce those, and then that Roth conversion that you're allowed to do. You can convert. You got to pay the taxes on it, but again, you kind of reduce that future tax liability at least somewhat.
Definitely. Thank you again. So we have another quick question that came in asking, what are some of the pitfalls for a beginning investor to avoid?
Oh, pitfalls for a beginning investor. Well, I would say one of the things I've actually had quite a few conversations with some beginning investors over the last 2 years or so, um, and uh, and most of the cases where I've been talking, they were a little frustrated because they were having trouble kind of making it work and those type of things. And when I dug into it, I mean, they were working with extremely volatile investments, had huge upside potential, and they're really, very, very volatile instruments, though. And what I've seen, at least in my experience, is that the more volatility, obviously the more upside you have, but the harder it is to do it right. And so you're a brand new investor and you're basically just trying to hit home runs. And it takes time. I mean, personally, I wouldn't go to a financial advisor to manage my money unless you've been doing it for 20 years. I think it really takes a lot of time to learn how to invest. And so I guess my first thought would be do some basics, try to hit some singles. Don't try to hit home run with everything. You can still try, but keep your home runs to kind of smaller dollar amounts and have your kind of core investments be more basics. And then, get some experience and just learn slowly but surely how to keep saving and keep building that asset base with your monthly savings. But have some core, investments that you might even think is a little bit boring, but at least they have a good chance of making some money, over a period of time. Because a lot of these volatile things, you make some money and then you have to get out at the right time. Otherwise you lose the money. And so, I saw a lot of conversations with people doing call options. Well, call options expire. So if you don't do that exactly right, I mean, you're basically going from T-ball if you're an initial investor to the major leagues. I just am learning T-ball, but I'm going to go, try to hit a curveball from, one of the Yankee pitchers. And so I would probably try to, practice hitting some balls off the tee first and then get a pitching machine, work your experience up a little bit more succinctly, and a little bit more of a planned out methodology before you start, trying to go into the big leagues, which is where you go with some of those volatility pieces. Unfortunately, the news is littered with those few people that actually did it. They made it and they made all this money, and then everybody thinks they can do it. What the news doesn't show is the 100 other people that didn't make it that ended up getting frustrated trying to do it. So I would say just work it up slowly.
Going off that, there's
Yeah.
also, you don't actually have to trade your own money. You could always do paper trading. You know, there's
Yes.
websites where you can
Yeah.
just practice.
Yeah.
And another thing is to learn your biases. Like, are you overconfident in making a trade? Do you double down on your trades and other stuff like
Yeah.
that to protect yourself, to learn your habits?
Yeah, that's a great idea. So I think, you could, even if you had some money, you could have a lot of it in some basic, even like this VTI that I just showed you, this total stock market index. You could take a small amount of money, because it's kind of fun, right? And make some bets because that could work out. And then open up a fake account with some fairly large dollar amounts and practice with that. And really, you can do anything with that usually, and keep working that. And then, as you get those worked out, you could maybe transfer some of those concepts to your actual trading, because everybody has a different style, and it has a lot to do with your own personal background, your own personal personality. So that's a great idea.
Another question we have in is, I'm considering hiring a financial advisor. What are some questions I should ask her to know that she will help me manage my wealth?
Ooh, okay, I say number one is how long they've been managing money, by far, because the technique of doing a financial plan is difficult, but not anywhere near as hard as managing the money. And if somebody messes up your plan a little bit and you get going down the wrong path for a while, that's nothing like losing 30% of your portfolio. I wouldn't work with anybody who hadn't been, and I mentioned this before, who hadn't been in the market and dealing with client assets, especially substantial client assets, for at least 20 years. I think it takes at least that much time to figure out what you're doing. And so there's an awful lot of people out there running around that don't have that experience. There's no way in the world I would give them anything substantial, especially my life savings, to invest unless they had that experience. So that's one of the first things I would ask. The next thing would just be kind of the costs. What are all the costs? Is there a fee? Is there an internal fee? Is there an hourly cost? If I call you up and want something, do I have to pay, do I have to pay for the financial plans? Do I pay for that every year? Or is that included? It would be really great to know the exact costs. And I probably would want to be out on some website looking at least some of the averages so I had some idea. If somebody told me it was X, Y, and Z for all the costs and that was average or better or way higher, I probably would avoid way higher. Almost impossible to make up a really expensive financial planning situation, in my opinion. Um, and so that would be another issue. And so those are the two biggest things that I would look at, that I think have the biggest impact on the scenario. And then of course you can go through a financial planning process. You can ask all kinds of questions during that process. You'll get a really good idea of what that person thinks about your situation and what they're recommending. And in that, you should be able to kind of tell, is this going to work? Can I work with this person? Do I trust this person? Because that's a huge issue, right? There's no way you're going to be able to actually figure out what they're talking about in total. I mean, if you could, you'd be doing their job. And so eventually it becomes a level of trust. And so, do you trust that person? And that's more of a kind of a gut feel. And that's why I always encourage people to go through a financial plan, even if you have to pay something for it. That's a great test to see how it's going to work and what's going to happen, and whether or not that's somebody that you really feel like you could trust. And so those are probably the trust, the cost, and their years of managing money. You really like to see them. I mean, I've been doing it for 35 years. I've been through some really big downturns. I've learned a tremendous amount. What I described today on how to handle a downturn, I didn't know when I first started. If you'd have worked with me 2 years in, I wouldn't have known those things. So that just takes experience and time. There's just no other way around it. And so that I would be super cautious about that, because whoever is managing your money, it is your life savings. So be careful.
Great, thank you. So there's been a couple of headlines recently talking about meme stocks. So what are meme stocks and why do they keep going up?
Yeah, the two main meme stocks are, GameStop and AMC theaters. I just saw a headline today that AMC was up 130% this week. And I've forgotten how much it's up for the year. Do you know that one, Eason?
I think it's up around 1100%. I think.
1100%.
Wow.
So this is a company, theoretically, AMC Theaters, that, one of the things that's happened to movie theaters is that during the pandemic, the studios bypassed the movie theaters really for the first time, and now you can buy, it's usually like $20. You can buy, a Disney movie or what have you. They didn't have tons of inventory because of the pandemic. They weren't really able to make, a lot of movies, but they did have some that they'd made before the pandemic. But that set a really dangerous precedent because I think they pay roughly 30% of the revenue to the movie theater. And if they can bypass the movie theater, that's a problem. So combined with all the debt that AMC had and all these things, there was a bunch of people shorting the stock, which just means that they were betting it would go down. And when you short the stock, you literally borrow it from a brokerage firm. And so let's say I wanted AMC, I would borrow AMC stock, I would sell it at its current price, and I'm hoping it goes down and I can buy it back and then return it, right? So if I sell it at 100 and it goes down to 50, I make $50 a share. So that's really awesome. And a lot of hedge funds do a lot of shorting. So what happened was there's these individual traders that got together in these groups. There's one called Wall Street Bets, and they started, running up the value of the stock. Well, when you do that, if you're short and it goes from 100 to 150 to 200 to, there's an unlimited loss that you could take. So and that means you actually have to buy it back, which makes it go up even more. And so that's become a really popular sport. And for the life of me, I don't know why these guys are still shorting. Um, there must be an amazing amount of money that was lost, for example, on the GameStop, the shorting people. Do you know, Eason, how much that was? I've forgotten.
Yeah, I think it's around $6.7 billion have
Oh
been
my gosh.
lost for short sellers,
So
and
think about that. So hedge funds or whoever was shorting lost about $6.7 billion shorting that stock. And these Wall Street bet guys, they're not going to go away. It's a pretty fun game for them. They love, going after people that are shorting stocks. Is GameStop a viable business, with all the digital streaming games? I'm not sure. Is, AMC really a viable business with all the streaming thing options that you have? I'm not sure, but I probably wouldn't be shorting it if these guys are trying to push up the price. So it's really fascinating. I guess the only question that I have, is how much does that affect the overall market? I mean, it definitely has some impact in that these guys are buying that stock or options on that stock and not buying other stocks. So it kind of takes away volume that could be going into other types of areas. So, sort of like cryptocurrency, same thing. People that are buying cryptocurrency aren't buying Apple and Microsoft and these other stocks that, that I own. And so that's a piece. But also, when the GameStop thing first happened, we saw about a 5% drop in the S&P 500, and that was seemed to be related to the fact that the hedge funds were having to sell other assets to cover their losses that they were getting on that first run up. We haven't seen as much impact at this point, but really pretty wild scenario that's happening there. But at the moment, it seems to be fairly isolated. For whatever reason, they're only really concentrating on these two stocks. And there's been some money made there too, not something that I would do or get involved with because I think it's too crazy. But it is really fascinating to watch and understand. The 6.7 billion loss for the hedge fund managers or the people shorting that's a big number. It's a lot of money.
So what are a couple of growth ETFs to watch right now? And what are a couple of dividend ETFs to watch for right now as well?
Oh, okay. Yeah, that's an interesting one actually. Let me pull up my chart again here, and we can look at kind of what's happening. And I'll share my screen. Oh, let's see here. All right, so we've got here's one growth ETF. So keep in mind that actually in the year to date, really the growth section of the market has not done that well. You can kind of see that here. This is an iShares. It's exponential technology. This is a really cool exchange traded fund that has a whole mixture of different exponential technologies, even in healthcare area and what have you. But you can see, the biggest gains came, prior to this year. This is the beginning of this year, and it's a ticker symbol's XT. But we currently have this in the portfolio, and we've made some money. We bought it, in this time frame. But one of the things that I watch for really is just kind of breakout. So if I draw a little trend line there, you can see, hopefully, see that little red line there. So theoretically, this thing has potential to break out above this line, and you could see a nice run there. And it's actually held up pretty well overall when you look at all of the different growth funds out there. So that's one we have in our portfolio and in our model right now. And then there's another one here I can show you. This is XITK, and this is Spider, which is State Street, one of the big money managers out there. And this is, again, an exchange traded fund. And this is a innovative technology ETF also. Now you can see that one again had huge run, peaked out here. The 12th of February was the peak for most of these things. And we still own this, not in our models, which we use in our IRAs, but in our taxable accounts, just because we still have such a huge gain. But I would put it in my models, especially if it breaks out. And you can see here on this trend, it's right there right now. So if this thing breaks out, it's got a lot of overhead resistance. See this big block of shares that was purchased here. It's going to make it hard for it to go, because everybody that bought here might be looking to get their money back, right? If they bought it down here and it runs back up, they might say, okay, I'll take it. But you can see if it ever gets through this level, which would be a really good buy area right here, because there's virtually no resistance above that, because there weren't that many shares traded there. So this is one I'd be watching also, XITK. I think it's worth looking at. It's now above the 200-day moving average. The 200-day moving average is going up, etc. So there's some potential there. I don't do a lot of dividend pieces, but one that I've been watching a lot is this one here. This is iShares. Again, iShares is actually owned by BlackRock, which is a monstrous money manager. This is called Select Dividend, ticker symbols DVY. You can see this is actually a totally different chart pattern than both of those. Went sideways, for most of last year, because everybody last year was buying growth stocks. And you saw that in those other two charts, right? I mean, there was a huge run up through here. But all of these took off on the 9th of November. See that big jump right there? And so the 9th of November was when Moderna announced their initial results from their phase 3 trial, which was very, very positive, and it turned out to be a really important time frame. And so dividend stocks tend to be kind of those value stocks on the other side of the equation. And a lot of these stocks are stocks that were beat down because of the pandemic. And so you've seen just a phenomenal run, very strong, way above the 200-day moving average. But this is a decent dividend stock. I don't buy things just for dividend, because you can get a 5% dividend and lose 10% on the price. The price is much more important to me than the dividend, but this would be one that I'd take a look at as far as that goes.
So, what kind of companies are in dividend ETFs? Like, what are value companies?
Well, okay, so generally speaking, when you're growing really fast as a company, you're putting all of your money into that growth development. Maybe you're buying other, growth companies or what have you. And so you don't really have money to pay a dividend. Oftentimes, when you see a dividend, it is either from a more established company, like Apple now pays a dividend, Microsoft pays a dividend. They're not huge dividends, but what you're normally seeing in this dividend arena, and really what's kind of running here, is what's called a value stock. So a value stock is just essentially a stock that is selling for, relatively inexpensive compared to its earnings, whereas a growth stock can be quite expensive compared to its earnings, but you're hoping that it continues to grow really fast. And so you'll see a lot of value stocks pay dividends. And one of the reasons they pay dividends, and sometimes they pay fairly big dividends, is just to attract investors. So AT&T was paying a pretty high dividend, roughly 7%. And then they cut it by 40% a couple weeks ago in a deal that they were doing to spin off, their Time Warner purchase. And their stock dropped. I think it dropped about 40%. And again, because people were buying that for the dividend, and so if you're going to oh, sorry, the dividend was cut by 40%. The stock dropped, pretty dramatically, but they were buying it for the dividend. And so that's a problem, but that's what you'll see in here. So, kind of industrials, your GEs of the world pay nice dividends, AT&T, older companies that are trying to attract people to their stock will pay a lot more dividends. And so, obviously that's been an area that has really improved as the economy has started to reopen or even thought about reopening, which started on 11/9 when that announcement happened. If you go through all of these value portfolios, you'll see this big jump here, and you'll see a similar pattern of gains that come from that point forward. So yeah, that's kind of what you're seeing in there.
Thank you, Tom. So we have about 5 minutes left. So I wanted to touch on some current event questions. So
Yeah.
many investors are hedging against market volatility as summer approaches. Do you agree with that and why?
No, I don't. Again, I am a huge believer in the concept of reaction and not prediction. And I know that sounds really strange, but I don't believe you can actually predict. So if you're trying to, get ready for summer volatility, you're predicting that there'll be summer volatility. I'm going to wait and see what happens and react to that if we have that type of volatility or not. Because, I mean, I've just way too many times I've seen people make predictions. Matter of fact, almost every time, to be honest. Especially the more people, for whatever reason, the more people that are making one prediction, the more the market goes the other direction. So I really don't, try to invest in that way. So it's kind of an indirect way of answering that question, but I just don't do predictive methodology. I do reactive. That's worked much better for me. Once in a while, I'll do something slightly on a predictive basis if I feel really strongly about it. Like right now, I do have a lot more money invested in things that I think will do well in this reopening. And I think the reopening is really going to start to take off, the second half of this year.
Oh, yeah.
And so that's a little bit predictive, although most of the charts look a lot like that dividend chart that I just showed you. So it's not like, they're at the bottom and falling apart. These are things that have already shown some trend. And to me, I'm reacting to trend. So, sometimes that trend is down and I'm going to react. I'm going to have stop losses and all these different things that I do. Sometimes those trends are up and I'm, buying those and looking at those. But I am overweight in the reopening stocks at this point in time, and they've only done medium actually since I got into them in March so far. But I feel great that they could do quite well. This is a really unique environment. But generally speaking, for something especially short term like volatility this summer, that's not something that I'm going to react to unless I need to, and I'm not going to do it in advance because I don't know that it's going to happen.
So,
Thank you.
what what kind of trends are you looking for? Like, what time period are you looking at? Like a month-long trend, a 2-week trend? Like, what time
It
frame are you looking at?
it depends on the market. So, for example, I mostly over time have been looking at 1 year, 3 year trend because we've seen some pretty sustained runs in different areas. So maybe 9 months a lot of times. But what's happened in since the pandemic started, that has shortened up quite dramatically because when the market fell apart February and March of last year, a whole section of the economy disappeared. And so, the trends had to be much shorter. I mean, literally a month, 6 weeks, 8 weeks. And we were jumping into innovative technology and genomics and, clean energy. We started that kind of in the early summer and we made great money on, and those trends have kind of petered out a little bit, here at the middle of February, because now it's rotating over into this reopening trade. Again, which I don't expect to last forever either. 6, 12, 18 months maybe on the reopening side, the value side. Uh, and so you have to adjust to the environment. And so if you're looking at, a 3 year trend in the middle of a pandemic, when the things that were happening prior to that pandemic are totally different. You're buying airlines that, where the traffic went down 96%. I mean, you have to respond to that. That was a sea change. It changed things. And so I'm looking much shorter now than I was as far as that goes. But um, I would say it's probably a roughly 9 month trend. I really like that. It seems to be pretty good, but it is, it's a little bit different right now. And I think that'll be true for a little bit longer. But I'm hopeful that by next year, we'll get back to some, more normal trends and things like that. So, we'll have to see how that goes. So, all right. Well, that's the bell that the market just closed, which means it's 1 o'clock. So we're we're all done. I want to thank everybody so much for coming, and again, encourage you to go ahead and subscribe to the channel, and hit the little bell if you want to get notifications of all the things that are coming out. And then please, send us some suggestions for topics for next Friday, for example. And again, you can send that Ask Tom at Go Live with Tom. We're monitoring that email address all the time, and so feel free to send things to that at any point in time. Love to hear what you'd like us to cover as far as that goes. So, thank you everybody so much for coming, and everybody have a really good 3-day weekend.